how does that work as a business model? If you're paying $10,000 a year and you're paid up on this $2 million policy in 20 years, you're paying them about $200,000. But
exactly 200.
Yeah.
Lower 200,000. Yeah.
But then at some point, since people tend to die, they're going to pay your beneficiaries $2 million.
But they invested your $10,000 a year.
It's John Hancock. You know, I mean, where does that coming from? And where does that? They take your money, they invest it. I think the John Hancock Tower in Boston. But they invest in buildings. They take your money and they make money. I mean, there's other things they factor into it. People have policies and they let them lapse. They'll pay for 9 years, 5 years. There's all kinds of law of large numbers where people do certain things and they make money off of them. I mean, they're John Hancock for-profit business.
So it actually works for them.
If they make money.
If you're really good at math.
Well, do you know what it costs to, you know what it costs to buy into an IPO? You have to have $500,000 in stock. You have to have $500,000 invested.
Mm-hmm.
So an insurance company has a lot of money to go invest in an IPO like Google.
But the biggest thing that they do is they hire really geeky, nerdy people who are really good at math, and that's really important, but actuaries, and they just crunch numbers all day to figure out the odds that a healthy young person is going to die, which are very low, and then you pay them all that money, and if they're right, you don't die for a very long time, and they had your money the whole time.
As an example, I'll give you, this really is getting, there's something called rate of return. I'll show you this afterwards. What is, if you give someone $10,000 a year for 20 years, and then 20 years, and then they give you $2 million when you pass away. If you pass away at the age of 80, the rate of return on that investment is 5.67.
Oh, that's it.
And they're making 10.
Right.
Well, they're making 10.
On average.
9, 8.
Or something, maybe you're doing something with it. Yeah.
Right.
So, and people are living longer through the age of whatever, 80.
What about return of principal?
Well, that's an example. I mean, there are this is a basic. When you get a whole life policy, it's all in the details how you structure.
No, I mean, but there's in the middle now. There's term that's return of principal.
Yes. There's all.
Right.
There's a whole range of. I'm trying to two basic kinds. There's all kinds of when you really get into it, decide what you when you determine a policy, you can try and decide what you're trying to accomplish, what you're trying to protect, what you're trying to do. And invariably, for most people, myself included, all I have is term policies. I have a bunch of term policies. Do I wish I had? I don't know if you guys have a whole life policy, permanent policy at any time.
No, those numbers were too high.
It's general for me too. I mean,
And also, there's a debate whether you get insurance as an investment or do you get insurance for the sake of insurance. The whole idea of insurance is passing the burden of a catastrophe off your shoulders to some other person or other institution's shoulders. So in other words, death is, we all insure our cars, we all insure our homes. Typically, we have deductibles. So, but we know we have to insure them because if, God forbid, a catastrophe happens, we don't have the funds to replace that asset. So that's really what insurance does.
Yeah.
And so our family seeks to do a term as opposed to whole life, again, because if we're going to invest, we're going to invest. If we're going to insure ourselves, we just buy
sometimes you shouldn't ask too much of an insurance policy to try and have it accomplish a lot of things, I think. And pay for college, this and that. It should be, so.
And the biggest thing is term is the cheapest and simplest way to get pure protection, which is really what you want. Whole life and permanent insurance, it's typically more restricted. You have to pay it each and every year usually, and it doesn't often give you the flexibility to stop making that payment if you can't afford it. So for the people in this room, it's generally going to be better to
have some.
I know you guys aren't AFLAC reps, but I'm sorry. But we offer it to our employees, and they offer a $10,000 life insurance as one of their things. It costs like $7 a month, and just about everybody took it. And I couldn't figure out what they were going to do with their $10,000, and so I asked them, and they said they don't want their family or whatever have to pay for burial, have to pay for those types of things. So if you can do it through your company, I mean, tons of companies use AFLAC or something like that. It's so cheap.
if you work for a bigger company, which we all work for a pretty big firm, a lot of companies will offer like one-time salary or
Yeah, I
something,
think yeah.
or up to 50,000 just as a complimentary benefit. But you usually are going to need a lot more insurance than that, especially if you're married and or have kids.
So, I mean, we could also talk about insurance for a long, long time. But I'm gonna skip one.
All right.
You guys, and
Just one quick question.
Sure, yeah, sure.
So what length of time is the longest term life insurance?
I think term, it used to be 30.
You can still get
You
30
get
years.
30-year
Yeah,
term,
you
so
get 30.
they reduced that, you can get 30-year term.
Sometimes
Is
you
that
have to do,
about-
sometimes you have to do a calculation, because typically the insurance get really expensive from the 20th to the 30th year. And again, as Joel mentioned, the insurance companies know a certain percentage of people do drop it, circumstances happen, and they just don't continue to pay it. So unless you're really also the type of individual that is going to keep it, you're paying a lot for a 30-year policy that some people don't keep. It's a lot cheaper if you're relatively young and good health, just to have 20 years.
Is it fixed rate?
Yes.
There is level term.
Level term,
But you
straight.
can get term that does graduate up. But most people
Most people,
try to get that level term.
Yes, it's
Year in,
$800
year out.
This is $800 a year, 20 years,
And
that's
then
it.
when you renew 30 years later, it's a lot more expensive because you're 30 years older.
Yeah.
And you don't know what your health profile is. If it deteriorated, like Joe mentioned, he has skin cancer. I got Lyme disease. So, you may find, usually you should get it young when you're in the best of health, because you're never going to be in the best of health. You can't get better than excellent. And typically as you get older, circumstances happen. So,
My question was going to be about the renewal, but you already answered that. Who decides if you're in the best of health? Do you have to go to a doctor and they decide?
Insurance is, medically underwritten.
Somebody
I
comes
mean,
to
you
you.
just answer.
Someone-
They come to your house and they like take a medical.
They come to your house, take
The
blood.
company Portamed, they came out 6 o'clock in the morning one day, the guy came out, blood pressure, weight,
the insurance company
took a little bit of
has-
blood.
Yeah, they're taking blood on my couch.
Right.
Yeah, Portamed, they come out, they come out and they do.
Really? Okay,
But the insurance company hires people to look at medical records,
okay.
to look at the blood tests.
Yeah.
And they'll determine, based upon their tables, what classification you
Yeah.
get.
Okay.
If you're
And
actually,
typically, they do go for your doctor's records. I mean,
Yeah.
You do
but if
release
you're
those
thinking
records.
about doing it, because they weigh you on the spot, and they check your height on the spot, so, like, the person who sold me insurance told me, wear
Right.
higher heel, higher soled shoes,
So
that they
your
don't
BMI
look
is
like higher
lower?
soled shoes, and I lost 10 pounds, like, I scheduled it a month out, I went on a crazy diet, lost 10 pounds, because that 10-pound difference
Yes.
put me in double A instead of A, or whatever it was, and it made, like, it was like $7 or $8 a month for 20 years, is a ton of money.
Yeah.
And I got an extra inch.
Awesome.
And frost shoes, I mean, we can use.
So the reality is most people will be getting term insurance. The issue is sit down and make sure you have enough. So it's a problem, it's an issue which can be addressed relatively easily.